motivation. We hunt and we hungry, we celebrating, turning nothing to something and celebrating. Markets changing, recalibrating. The first to get acclimated is the first to stack the payments, but you need to act with patience, but be careful waiting, cause this opportunity won't last forever before it is evaporated. So if you wanna flip some houses, hit me up to make a plan. Your flip deserves the upper hand.
Hey everybody, welcome back to another episode of Raising the Flipping Bar. I've got Jesse with Indicate Capital with us. I'm super excited for today's episode because we're going to get back to one of our staples, which is having really smart industry professionals in the real estate investing space, but in a very, very adjacent and closely related field to us as flippers, but an important piece of the puzzle. So you guys get ready for an awesome episode. Jesse, welcome to the show.
Thanks for having me.
Yeah.
It's good to be here.
Absolutely. So we'll dive in. I would love to kind of get a little bit of information about you and your background. I think it's unique. And by unique, people in real estate seem to change all the time. They're in and out of real estate. They fall into it. I'm the prime example. I was in, professional sports before I got into real estate, but yours is a little different. Just tell us a little bit about your background.
Yeah. I grew up in Colorado and the son of a builder. So real estate was always comfortable to me. Housing, houses, construction sites. Yeah. And so, went to CU Boulder, got a finance degree. I actually had a marketing emphasis initially, and I figured I needed to figure out something that might take me a little further personally. And so I switched to finance, and then I developed this kind of a pursuit of real estate finance and what that really means. And I was always fascinated with this concept of, how do these big giant, developments and institutional sized deals actually get funded? In my mind, I'm like, oh, well, there's only, no matter how rich you are, you only have so many dollars. Right. You read about these projects. It's $1 billion project, $100 million project. I'm like, how in the world does that happen? And so with that kind of pursuit in mind, I went through, finished up school in Boulder. I was a ski instructor for a little while.
Oh,
and
nice.
With that was more of just like a fun little moment that I wanted to make sure I did. But
what mountain were you at?
Down in Telluride.
Oh, nice.
So I grew up down in that part of the state.
That's right.
Kind of went back there. And I used that as an opportunity to meet people. I had this unique ability to access these executives that you never would get access to as a 22-year-old kid or whatever, right? And so I'm riding lists as a ski instructor with CEOs of multinational corporations and whatever it might be, startups and all this. And so I was always asking questions and just kind of hungry for that. And so I had this desire just to learn it. I had developed a couple of mentors that came out of that.
Cool.
One out of Texas that was willing to kind of open up his platform with what they did. He was a developer and let me come, shadow and see how things happened.
Cool.
And so I guess that is the genesis that I had in finance. I personally started selling real estate after I was done skiing. I started selling real estate, and I the idea of developing skills over just a job, that's very important to me. So a college professor of mine in school had, said, one skill set that he talked about was sales. And really more of that is persuasive communication. Not trying to convince someone to do something that they don't want to do, but being able to effectively communicate your thought and how that can scale. And that could be everything from selling a widget to a buyer. That can be sitting in front of a boardroom and communicating your vision for a giant corporation, or it can be, you can use it in your home life, for, talking to your family or trying to, go on a date and, all the things. So
sure.
So I kind of had that in the back of my mind, and I thought, well, what do? I could sell something. I'm comfortable with houses. I could talk about houses. I'll sell houses. And so I got my license and started selling. I never really wanted to be a real estate broker necessarily, but that was a catalyst. Yeah. So that kind of launched me into the world of my own real estate career. That ran right into 2008 and 2009, and I learned what a recession was, and that was kind of cool. I mean, it's hard, but I was in my 20s and really trying and going for it, and teed up all these things. And I looked at my sales pipeline. I'm like, man, I might make some real money this year. This is so cool.
This was pre-crash.
So this is running right into the crash.
Right in the crash.
And then I just watched those deals just fall off the pipeline one after another, and it's like, okay, so you can't count your chickens, and so that was a neat education at that point in my career. Went back to school during that lull and got my MBA, and that was more, people ask me, is that something that you need to do to get into the industry or whatever.
Yeah, talk about that. It's
And
important.
I don't think it necessarily is
Okay.
from an education standpoint. I think it's
Mhm.
more of a personal thing and how you want to use it.
Yeah,
Yes, I learned a lot more.
of course.
Yes, I got to work on more projects. I got more experience than I normally would.
Yeah.
And so it's kind of an accelerated experience, but it's also relationships.
Yeah.
And so you come out of something like that, it's in an industry or a region that you want to work in, and you hopefully know some more folks that are going to go on. It usually attracts go-getters to
Yeah.
something like that. And
True.
so, like anything else that would attract that type of person, you want to be networked in with those folks and surround yourself with those kinds of people. And so
Yeah.
that was how it went for me. So I did that in Denver, and plan to, be around the Denver, Colorado market, for
Nice.
the bulk of my career. And so I wanted to lay down roots there. And so that kind of helped spur it into like this pursuit of finance for
Okay.
real. So
Yeah.
we're coming out of the downturn at that point. I had taken on an internship that turned into a full-time role for a commercial mortgage banking shop. And that's a role that's essentially you're a middleman for debt and equity placement for projects. So I
Okay.
was learning from these guys that had an immense background in that, in the capital markets industry nationally. And so I was just a sponge, just really starting to synthesize some of these components I've been hearing and learning about along the way. And at this point, I'm late 30s, and I got to really be hands on, underwriting and doing deal analysis and, cold calling fund managers in New York, all the above. Like it was a really cool
Yeah.
education. And that's where I really started to, I think, drill into that financing component and understanding the capital stack, buzzword,
Yeah.
the capital stack of a commercial real estate deal and how that can really look, and then how joint venture partnerships can be structured and
Yeah.
what you're looking for and how you're underwriting those things. And so kind of took that and ran, and that firm sold. I moved on and ended up in a role as a community banker in downtown Denver, and never in a million years but I thought that I'd just, be working at a bank. Shops doing commercial real estate deals are not just banks, or especially
Hmm.
local banks. This bank, coming out of the downturn, banks had the balance sheets all messed up and TARP money going into the balance sheet and all that messed things up too. And so this bank had a clean balance sheet, they're well capitalized, and they wanted to do real estate deals. And
Okay.
so I was a non-traditional hire as far as banking goes.
Yeah.
And the agreement, I kind of told them, I said, if you want to do real estate deals, come on, bring me on and we'll do it. If you want somebody to do accounts receivable lending or manufacturing
Yeah.
lending, that's just not my forte or backgrounds.
Yep.
So we went out, and it was we're just starting to ramp up. I mean, at that point in time, the only construction getting done was really ground up multifamily.
And what year where were we at year wise?
Yeah, year wise. So I was at the commercial banking shop 20 end of 2010 through 2012. Went to the bank at the beginning of 2013. So we've just really been seeing ground up multifamily.
Yeah.
All the national home builders had pulled back on
Yep.
construction. It was fix and flips happening. I had a big foreclosure boom.
Yep.
So that was all happening. And then slowly this, Denver really started to come on the map as far as people relocating for lifestyle. And there was opportunity here. And so started financing a whole bunch of townhome construction
Okay.
and single family home construction, infill stuff in Denver. That
Cool.
new supply kind of was complementing the renovation of existing housing stock, and just adding. The whole name of the game at that point was adding housing units.
Right. Because we were behind still.
Because we were way behind.
Yeah.
And the forecast was it's going to take, we got to build everything that we could possibly build for like a decade. And that's kind of what we did.
Yeah. True.
And so that's kind of how I got into that portion of that. And along the way there, met my current business partners who had a hard money lending platform operating, and they built that to really partake in that foreclosure boom that the market was seeing, and started to get entrenched in that fix and flip, just down the fairway, buy a foreclosure auction deal. And you know how those go. Like you get this small group of people kind of like you sort of helping each other out. Touch that one, but I want this one, and all of that. And so, I think they had gotten into it, it was their first forte into kind of a fund structure and hard money lending and all of this. And I started to see the opportunity there. At the same time, I'm just running down this, bank financing route, and we kept bumping into each other on deals and all
Okay.
that, and we were friends along the way too. And so they invited me to join them and kind of launch uh, the next iteration of their platform, which became Indicate Capital.
Gotcha.
There's another partner involved there too. So the four of us kind of took this thing and started building it. And the foreclosure boom had waned off at that point. We really haven't seen that. We aren't seeing that.
Yeah,
right
I
now.
agree with you.
So then it became more of a scalable platform. So, there's a need for private debt in all the asset classes of real estate. There's a huge growing demand for that. Like every year, maybe not the last, year or two, maybe, but for over a decade, every year, the capital raised globally in the private debt space, debt fund space, would like just completely outstrip the year before. And so there's this move towards private capital as a source of capital. And it's a legit source of capital. And it's a legit source for giant institutional type of investment groups down to your very local fix and flipper.
Yeah.
So there was a negative connotation sometimes associated with hard money, like, oh, you can't qualify for a bank loan or something like that if you're doing a construction project.
Yeah.
Doesn't really apply to fix and flip lending because banks can't really touch that because it just moves way too quick for what a bank can do. And so we just saw this growing opportunity. So we launched a fund and we've been raising money into the fund and deploying that as loans into our run of the mill is a single family fix and flip. It's existing product that's getting renovated. We'll do all kinds of, project scopes and sizes. There's a time and place for all of them, I think. But that's been a really nice growing business. After kind of a few years in banking and a year behind the scenes creating the platform for Indicate Capital, we finally were able to launch that just about 10 years ago now.
Yeah. Oh my gosh, it's been 10 years.
Yeah,
That's
it's been
crazy.
wild.
Well, and I think it'd be really helpful for you to explain to our audience. You're right. You brought up the term capital stack, which is a good buzzword, but I think it's an important piece of the puzzle, even for kind of independent investors that are doing a couple flips a year or people that are doing major volume. Yeah. Explain the capital stack, where you guys land as private and hard money lenders, but just that concept I think is interesting.
Sure. I mean, I think that it's called a capital stack because the visual is, a bar chart, and you got this stack of cash, and some is your cash and some is other people's cash. And sometimes there's many different people's cash involved, and different levels of that stack has different risk profiles and different return metrics. So on one hand, you could see a house, buy a house, all with your cash, do the renovation, and you make whatever you make, and that's your return on your cash. You got 100 grand, you buy that house for 100 grand. Now, if you want to split that up and buy two houses, you got 50 grand and 50 grand. You need to, but the house still costs 100. You got to go find other capital. So you might raise that from private investors, be friends, family, or whoever, and you pay them some sort of range return. They might share in the profit, or it's a fixed rate, or a combination of both. Or you might go borrow it from a lender like Indicate Capital. And if you're going to borrow it from a lender like Indicate Capital, that's going to be very standardized terms that are arranged at the front end, and there's going to be an interest rate. There's going to be a loan payment structure set up, and then there's going to be a timeline. So that loan will mature. So that lender wants their money back at some point and all that. And so usually a lender would be kind of last in, first out, if that makes sense. So I want my dollar to be the last dollar put in. I want to get paid off first before everybody else. And then I'm going to have a standardized rate of return. It indicates typically 14%. And that's just arranged like that. Now, if I raise that from a friend or a family member, I might be able to figure out whatever structure. It might be an annualized. I might say, you got 100 grand, I can invest that in my deals. I'll pay you at the end of the year based on how things shake out. I might pay you a fixed rate return. So multiple different approaches there, but so it's kind of debt and equity on that bar chart. You got equity is your money up here, and maybe equity as raised equity from friends and family. And then there's some kind of debt component typically. It's usually hard money or something.
Yeah. And I think our industry is becoming kind of more, it's interesting. It's becoming more sophisticated. It's becoming kind of more grassroots. And we'll talk about this here in a second of why interest rates have gone up, but private and hard money lending rates have come down a little bit compared to a couple of years ago. I would just love to get your take because everybody's a little bit different.
Sure.
Those two things.
Yeah. I think if you lined up up 10 people, you probably get 10 slightly different answers. But I think in general, a broad stroke would differentiate those two from hard money would be more of a, think of like a business oriented fund structure, kind of regimented platform. And private money can be truly private. It's coming from an individual or a group of individuals. And so it might not be a fund structure or anything like that. But there's a lot of gray area in that. I mean, and a lot of lenders, including us, will use the terms kind of both ways. We're hard money lenders, we're private debt fund or whatever it might be. So
Gotcha.
you want to, clarify that as you're talking to somebody or listening to somebody, and you can usually tell, based on what their platform is. They can be used interchangeably, but the idea of hard money is that you have access to capital with a level of certainty, and it's readily available. That's the hard part of it. It's right here. It's cash. It's dollar bills. It's ready to go. So versus a bank will take a month or two to underwrite something or whatever. By then you're already done. So, so that's the idea, I think.
Okay.
There.
Yeah, that's great.
Yeah.
Well, and I'd love for you to kind of share, you've got a diverse banking background. You're into the hard money and the private money lending space. To your point, you came up through the real estate world, got your classic education. Is there a skill set that now down the line that you think, man, either I didn't learn it in school or you had to learn along the way that you're really using today?
Sure.
I loved your analogy on sales. That's something I actually tell my kids right now who are college and high school kids. I don't care what you do. You have to be able to sell yourself. You have to be able to sell something. But yeah, maybe a skill set that you're like, man, I didn't see that coming, but I do this a lot.
Yeah. I mean, definitely that sales skill set of the persuasive and effective communication. Along the way, if you just looked at real estate in general, there's a lot of different skills needed in the way you look at things. But I think ultimately you can boil a few things down to, for me, I want to be involved and invested in something that I understand and be willing to say that I don't understand something. So making data-based decisions. So like I indicate, we try to do a lot of analysis on all of our projects. And if I find myself making a decision and it's difficult to come to the conclusion, that's like a red flag. And I stop my back up and I say, maybe I don't have enough information here.
Yeah.
So we really try to rely on that. Now, sometimes you got to just go with a gut on something with, pull the trigger on a deal or a finish or, this versus that. There's definitely that involved. I think having a plan, so you have an objective with what you're doing and then sticking to that plan and being analytical along the way and real with yourself. And I think that's something that I've watched a lot of people and I've fallen prey to, is that you get into a deal and it's like one more step, one more thing. And you look back and you're like, how did I end up where I am now on this deal?
Yeah.
I should have stopped this a long time ago. I should have, seen this red flag come up. And so the ability just to stay realistic with yourself.
That's a good one.
And that can be different ways. It can be writing it down and checking in with yourself, having a mentor. It could be a partner, whatever it is, but just being real about that. The reality in the market will be outside of your control. And you have to just be real.
Yeah. No, I think that's really well said. Well, and what I would love for you to share is also, I think you framed it really well. We've got hard money, we've got private money. What you guys are doing at Indicate Capital versus some of the other hard money lending partners out there is a little different. How did you guys, maybe tell us about kind of your bread and butter terms when you are lending to flippers like myself?
Sure.
And then maybe how that differs to some other people in the market that are also very successful, and it's just different models. So
definitely. Yeah. There's lots of different models. So our model is set up in a way that's supposed to be low barrier to entry. So we don't charge points. We have, $1,000 document fee to close the loan. So very low cost to get into it. And we have a 14% interest rate that's charged just on the money that's outstanding.
Yeah, that's huge.
Meaning you get a construction holdback for the rehab of a house, not being charged interest on that until you're using it. And that's meaningful. You have a large scope of work. And so our whole fund is set up, or our platform is set up to have quick access to capital, low barrier to entry. We're not charging appraisal fees. We're not waiting for appraisals or anything like that. We're going to underwrite it in-house and then come to terms, agree to those terms, get the loan closed. We're doing loans very fast. And then there's no prepayment penalty or minimum interest. We like to get a month of interest. That's usually pretty easy to accomplish. So it works great for flippers. Our average deal is outstanding for about on the fix and flip side, about 5 months,
Okay,
maybe
that's
6
good
months,
info to know.
somewhere in that range.
Okay.
And we've seen that come down a little bit. Of course, that depended on the project types and
Yeah.
the sales market and all that. But it works well for that because then you look at that. If you're, say, it's 6 months, easy math,
Hmm.
your overall cost of capital on your project is roughly a 7% all in cost out in the capital markets. You're talking about capital stack. That's not that bad, actually.
Yes, good way to say it.
And so I think as long as it's, we have lots of models that can show the differences and break
Mhm.
even points on different loan structures. And there's lots out there.
Yeah.
We're not charging big fees for draws. If there are draws, collect that up front. It's an extra $400 on top of that fee.
Mhm.
But we're not charging big fees. There's no hidden prepayment penalty fees or these weird extension fees because you get like these 3-month loans or whatever like that.
Yeah.
So we're just doing a 12-month loan, no prepayment penalty. We have an extension option that's built in there. Many times that's not being needed, but it
Yeah.
is there if it's needed.
Yeah.
And so that I think is what is attractive about it. Then the intangible component is we try to provide a really high level of service. We have a lot of repeat borrowers. That's the bulk of our business. And so we know them and their business just as much as they know us.
Yep.
And so when we get a call or an email from those folks, we can respond quickly. We have a certain trust level of their underwriting. We kind of know what to look for and the questions to ask about that deal. We
Yep.
kind of have an idea of the quality of finish that they're going to do. And so it just can speed the whole thing along. So
Nice.
it's very common for us to get, deals coming in over the weekend and the early part of the work week and have them closed by the end of that work week. That's our business. So we have to be able to respond
Sure.
to that and perform. And so I think that platform can work well for that type of
Yeah.
thing.
Yeah. Well, and I think that's almost like a perfect segue. I would love to hear because you're seeing so much more volume than me as a flipper is doing. Even if I'm doing 20 projects myself, you're doing 200 or 2,000 or whatever. So maybe give our audience a sense of, and I'm focusing on the pivot point of like $1 million and less, because I think that obviously the luxury market, which I would argue now in our market is getting close to 1.5, but that's a different animal. It's a different beast. Not as many people focus on that, but kind of the bread and butter people flipping under $1 million. What's maybe maybe one of the best deals that you've seen, and maybe also just a double. If we're using a sports analogy, I think it's important to talk about where people can go, but like, what's your bread and butter too of what you're seeing out there of people's rate of success?
Yeah. I mean, the bulk of what we're doing is right at that, median house price in the Denver market. So that makes sense that that's the bulk of it. And, the ones that we've underwritten there, we're seeing, if you look at all of 25, seeing profit margins pull back a bit. And there are a couple of things going on there, but average profit margin on the deals that we've seen this year is about 15% all in. So that's taking all the rental costs, all the acquisition costs, disposition costs, everything, holding costs. Leaves about 15%.
Okay.
So that's pretty typical. Of course, we've seen folks hit that home run and they might, they might double their cash on cash. And we've had losers too. That, like you said, that market that's in that kind of median home price is a good place to be. Houses are selling there, but they got to be done right and located well. Conversely, we do see deals north of $1 million or north of, it's just a lot of eggs in one basket on those. So as a flipper, I think there's really good profit margins there. But you got to be prepared for it. It's not like you can just go into it from the one category into the other category. It's almost like a different business.
It is.
So that's the first question we ask. It's like, if we're seeing those luxury ones, it's okay. Really important things to consider that translate to the other side too, I think, is hold period. Do you have the cash available to hold this thing if you need to, if it takes longer to sell? Do you have the right crews for this? So luxury would be a crew that's experienced in that luxury market. They do high-end finishes. They use those materials, whatever it might be.
Yeah.
And then you also have a source to get good deals on those product types. That also translates to the other price points, I think. Conversely, you can't take that luxury trim carpenter and go put them in your $500,000 house. It's going to pay way too much.
Yes. Good. Great point.
So that's what we're trying to balance always. And so I think the hold period is what is tricky. And then also budget. People underestimate a budget all the time.
Yes.
All the time. And then they'll come back to us as kind of the easy phone call and say, hey, I didn't know about this. I need a little more money. And to a lender, that's a red flag, a real big red flag. So a good lender would be hesitant to want to just dole out more cash because
Yeah,
theoretically my value, my ARV hasn't changed. And so now you're asking me to increase my dollars in, which means increase my risk profile.
sure.
We would push back and say, no, borrower, that's on you. We should know about that up front. We don't always do that, I'm saying, but
Yeah.
that's kind of a thought process.
Yeah.
So that's when it helps to have that good relationship with your lender. It's just not like this bureaucratic kind of corporate process where you're calling this salesperson. They got to go to this other group in another state and all that.
Yeah.
So a group like Indicate Capital, we're hyper local. We're right here. You can call us and you can get one of the principals or the loan originator or the underwriters in the
Mhm.
car or all of us and go to the house. We can walk in and talk and
Yeah.
figure out a plan. So
No, that's really well said. And I do think that's super important and something that we'll talk about with the deal that we just did with you guys is that's
mhm.
exactly what happened. And you got to have that as part of your business model. You got to have that as the reserves that you have. I mean,
Yeah.
that's obviously super important. Maybe that would be one thing before I got one other topic I want to hit, but you talked about not having maybe reserves or that foresight or rehab. Is there one other thing that you're seeing in the market of the deals that are not going so well that you could lend a hand to the audience and say, hey
Yeah.
guys, watch out for this because you're starting to see something happen more often that people need to be aware of in addition to smart rehab budgeting?
Yeah. I think I'm a big proponent of contingencies. You got to have
Yeah.
a contingency. And I know that you teach that in your classes and that. And that's
Mhm.
so smart because a lot of people don't.
Mm.
You'd be shocked at how many people don't build in a contingency. The other thing is hold period. So you got to plan it accurately for that. You might have the best thing going, but it still might take a little while to sell. And the time
Yeah.
of year, as you know, and teach matters a lot. Well, so we see a lot of flippers right now kind of trying to build their inventory, remodel it through the winter, and then sell in spring.
Hmm.
That's ideal. But some other things that we see level of finish, you cut corners, or it's easier to see in the high end market where you bring in the incorrect finishes. You do a $600,000 house type of work into a $2 million house or
Yep.
whatever, and that's not going to work. And so being realistic and having a nice quality finished product, you got to have that.
Yeah.
It's got to pop. It's got to be thorough. It can't just be kind of sweeping it under the rug, covering something
Yeah.
up. People will know that.
Yeah, and I think that's really smart. And I would want you guys to go back and listen to what Jesse said. It is that level of finish is so, so important. We had a client who was doing a flip and, they made a comment that says, I can't afford to do nice landscaping. Well, that is old school 101 too of the curb appeal. When you pull up to a house, if it looks like crap, they're going to think the inside is probably not the
Yeah.
best, or obviously it doesn't look good on photos. So yes, it's painful, but even if it's, in my humble opinion, like borrowing the money from a private person, because that extra maybe $10,000 of landscaping, if it sells your house and saves you a couple months,
Yep.
you're better ahead. I'm paying you $5,000 a month in holding costs. I'm paying that $5,000, but if I eat 4 months of it,
Yeah.
I've lost $10,000. So you guys listen to that at home. I think that's a really, really good point. Again, it's painful, but you have to do it. It sucks, but that's the market.
Yeah. The flippers that we see being successful have a plan in place. They've built, a system, whether it's in-house or contracted folks that come in and do the work.
Yeah.
And their underwriting is, regimented and they operate per that plan. So the day they close, they got crews in there
Yeah.
that next morning
Yep.
and they're working. And it's not sitting on the market or not, it's not sitting without anything being done for
Yeah.
long periods of time because that clock is running. And so that kind of time is money and time is cost.
Yeah.
And it's just eating into your profitability at that point.
Yeah.
So that's important. We also saw kind of in the post-COVID era, on the ground up and the permitting process in the city of Denver
Right.
was brutal. So we saw a lot of builders get caught in that. I mean,
Right.
to the tune of like a 12-month delay on
That's
that
insane.
project, 12 months behind what they thought would be already, a permitting process. So that's been a real struggle. And kind of to that point, then a little
Mhm.
segue here is, the new construction has been slowed so much. So
Yep.
big nationals holding back on bringing new supply or subdivisions to the market.
Yep.
That's slowly changing right now, but they've been held way back. Local builders and investors, they've kind of had to clear out of their inventory and they can't find sites right now, or they don't want to, or they're stung so bad they kind of got to lick their wounds a little bit still. And so
Yep.
there's this opportunity right now in the fix and flip environment. You're taking infill existing housing stock and you're able to create housing that's attractive to, young families moving out from a condo or townhouse or something, or whatever it might be, that's an opportunity where normally that buyer might also be looking at, as they're shopping, they're out looking at these subdivisions out of the urban core or whatever it might be. Now it's like, oh, they can buy this house down the street, not as far from work, still go to some shops and restaurants and things. So I think that's a real opportunity in the fix and flip world right now.
Nice. Yeah, I think right. I saw an article that existing home sales are higher than new builds. And you would think all things being equal, somebody wants something new. It's almost, let's use a car as an example. Do you want a new car or a used car? People are paying, I mean, this is maybe a weird analogy, but they're paying more for a used car than a new car if we switch that to housing. But it makes sense because of what you just said.
Yeah.
I think that's an important piece of puzzle. That's why we're still doing what we're doing. And I don't touch the new builds and don't touch the scrapes and just not our model. So.
Yeah. Yeah. And it's different models in each one of those things for sure.
Yeah. I would love for you to hit, we hit it early on, but I want to hit this before we go to my next topic in my notes is I was really surprised and people ask me, especially when they're just getting into the business, interest rates in the middle of 2022 obviously started to skyrocket. That set off what became a very challenging 3 years. And who knows, could be another 1 or 2 challenging years where you would think regular interest rates, what people are paying for mortgages, traditional mortgages on their credit cards, car loans or whatever went up and it went up fast. But we saw private and hard money interest rates come down. I have my theory, but I want to hear from you. Why do you think that happened across the market? I know you guys have been pretty consistent, but I'd love for you to share with that, to our audience, because it doesn't make sense until you probably hear what you're going to say.
Yeah. I mean, I would say ultimately it's competition. It's more money coming into that space.
Right.
Which is good for the borrower, I suppose. There's a lot of groups out there. A lot of institutional money has tried to create like a hybrid localized kind of platform. And sometimes that sort of works and sometimes it doesn't at all. And then there's just the ability to attract capital in that. It's a very nice place to be as an investor if you want to be involved in real estate, but you don't want to be involved or don't know how to be involved in the day-to-day of actually buying a building or whatever it might be. And so there's a lot of groups out there expanding and growing. And so I think competition ultimately.
Yeah.
Yeah.
Okay. No, I think that makes perfect sense. I want to switch gears a little bit and I want to talk about the deal that we did with you guys, because as everybody knows, listening to this podcast and watching, we're big proponents of sharing wins and sharing losses. And so you've actually brought up a couple facts that teed up kind of what just happened to us on one of our deals perfectly. So I'm going to give kind of some high level details to those of you guys that are listening. Definitely tune in next week because we're going to go deeper dive into this specific property. But we did one with you guys on Oxford Street in Englewood. And what you described was the exact reason of why I wanted to do our first deal with you guys is it was a smaller house. It was super fast. It was a cheaper price point, and I didn't want to pay points. In our world, for a 1,500 square foot house that was cosmetic, we can get in and out really fast. So the numbers made a lot of sense. So to give you guys some context and background, this was a 4-bed, 1-bath house, about 1,500 square feet in Englewood with a 1-car attached garage. And it was just a quick flip. So we bought it for $375. We had an initial rehab budget of $33,000, which for us is really cheap. Normally we don't get lucky and get these cosmetics. And then we had about a $485,000 sales price point. So that would have netted us about $33,000 in about 75 to 90 days and been a 54% cash on cash return. So for us, that's a kind of a single into a double, a very quick turn. Cliffhanger and newsbreaker here is it didn't go that way. 2 price cuts later, we ended up selling it at $455. We held it a total of 130 days and our rehab budget went from 33 to 43. And I'll give a quick kind of scenario of why that happened. And I would love for you to hear from a lender's perspective, what's going through your mind and what people are seeing in the market. But a perfect example is we're pretty damn good now, 10 years in of budgeting for rehab. My famous last words, I've never seen this before, where we had some leaking going on in the basement and we thought, why is this happening? The rain had stopped. We had filled the gutters and the grading was proper, whatever else. The entry front steps into this property, this was one of those weird old homes in Englewood where they changed everything around. There were actually, we ripped off the wooden steps and found 2 small teeny basement windows that had been drywalled over so you couldn't see them from the inside of the house. You couldn't see them from the exterior. And then water had eroded down as they were just going in these windows and then just going down the wall and leaking. So we had to pull out all the carpentry. We had to get rid of the windows. We had to reframe, reinforce the foundation. And then we decided to, again, fix the problem the right way. We just poured these nice new concrete steps, problem solved. Well, yeah, I mean, it sucks, but my rehab budget didn't have that contingency. While it was on that one, 12% of 33 grand is not a lot of money.
Sure.
So we burned through that, and fast forward $10,000, that was our loss. So we lost 9 grand on that property because it was such razor thin margins. So again, I want to be transparent and share with you guys that not every deal goes great, but hearing it maybe from my side of the table, I'd love for you to give the audience kind of your play-by-play of the good, the bad, the ugly with that one, because not every deal goes right, but you just got to do what you got to do.
Sure. Yeah. Not every deal does go right. And
Mhm.
a lot of them don't actually, probably. And I think, you and your team communicate so well through a
Mhm.
project. And that means a lot as a lender. Cause I mean, we're not there every day
Right.
at all.
Right.
We're very distant from a project.
Sure.
And so we can investigate, we could drive by, we can do all these things, but you're going to know way better. And so
Yeah.
that communication goes a long, long way. And also, I think you're realistic with your pricing. And so we've seen a lot of borrowers be unrealistic with
Mhm.
market conditions as it relates to their house. And so they'll hold on at that higher price point. And you got very aggressive with price cuts, and you were diligent about that until you sold, and that minimized the bleeding in the
Yes.
case. And that's so important. So as a lender, we were never nervous because we watched you do, all the right things. You did a good build out, you delivered it. It can sell. It's just what's the market going to bear right
Mhm.
now? Unfortunately, it just was a little tighter then. But if you look at the days on market and from the moment that you put it out there, I mean, you sold it effectively.
Yeah, we sold it
I think you
quicker
went
than the
under
average.
contract in about a month. Is that
Yes.
right?
Yeah.
Give or take.
Minimum.
And so think about that, 2 price corrections inside of a month.
That is pretty crazy.
That's regimented, that's staying after it. And I think that's hugely important. And that's kind of what I was talking about earlier, is a lot of people are unrealistic with that. They're like, no, it's this price, and they're kind of attached to that price.
Yeah.
And so removing that emotion, you're like, don't, cut and cut price, let's sell this thing. And you
Yeah.
found that market. So from that perspective, we had a comfort level.
No, and it's funny what you just brought up, just made me think of something. So I come from a Wall Street family. My dad was 40 years as a bond trader working on Wall Street and owned his own brokerages, and my whole family's in that. And I learned a lesson at a very, very early age about kind of old school supply and demand. And I still hear him say in my ear, something is only worth what someone is willing to pay for it.
Yes.
And so to your point, we had data and comps that said maybe 500 actually might work. But to me, that was truly just a little bit of a flyer to hit people that were searching between $500,000 and $600,000.
Sure.
But I told our agent at the time, Adam, I said, if we don't get offers first week, we're dropping the price. I think some people would be like, oh, that seems like a desperate move or a fire sale. I'm like, no, the market's going to speak. Then we got down to 485 and modest traction, but I needed to move it. More importantly, I needed to have the capital back to buy during this period
Yes.
that you just talked about. So we cut it again and sold it. But I remember I was a kid and we were baseball card collectors. And I told my dad, I was like, look at this price guide. I have a Ken Griffey Jr. rookie card and it's worth $100.
Mhm.
And he's like, great, you should sell it. And I was like, oh, okay. And no one would pay me $100. And I was like, but the guide says it's worth $100. And he's like, something's only worth what someone's willing to pay for it.
Sure.
So to me, it's like, yeah, this great first time homebuyer family was willing to pay $455. And I was like, sold to you. Let's move on and do the next deal.
And that's staying diligent to your bigger picture, the operation. And so you got that goal and you have the ability to remove the emotion and check in and say, okay, this is the bigger operation, bigger wheel spinning.
Mhm.
And this house, if it sells at this price, especially this price, it'd be nice to make money, but also I need to redeploy that. And I'm leading cash to, my private lender or my hard money lender, whatever it might be. So I got to recycle that and get back in the game. And I mean, in that case, with those numbers, you'll make that up and plenty more on the next deal.
Right.
And so you just got to get back into it.
Yeah. No, that's well said. Well, and I want to be sensitive of your time. So guys, as we kind of come down the home stretch, the two things that I'm always asking, my friends and people on the podcast is stuff about AI. And then of course about the market. So I would love to hear kind of what you are personally doing. And it's funny because in my notes, I said in the business, you can share if you use something personally, but how are you using AI in today's, crazy market environment? Because I think it's so.
Yeah, it is so important. And I'm probably not the most exciting guy to ask about that, just spoiler alert. But, we Yeah, we do use it, but there are groups that are really relying on their underwriting.
Mm.
They're building these algorithms and like AI can underwrite through a deal or budget a renovation and all
Mhm.
that. And we haven't gotten comfortable with that
Yeah.
level yet of detachment. But I think as far as more like data sorting and management, we
Okay.
use it there.
Nice.
You know, especially with call lists or, mailer lists or whatever, you can cull your data down pretty quickly using some
Yeah.
tools like that. And then the other thing that we've just kind of started trying out is, as a lender, sometimes we take back properties and end up owning them. We have to
Mhm.
do the renovation ourselves,
Yeah.
sell it or whatever. And
Good point.
using it for some of the graphics, like staging and
Oh,
things like
nice.
that. So there's some neat tools out there, but that's real surface level, and
Yeah.
there's a real deep world to go into there. And we just haven't really built the platform for our internal analysis quite yet. So it's more fact checking stuff and data sorting at this point.
Yeah, and I think you bring up a good point. It's what we are using now and what we could or want to use in the future. But the crazy thing about AI is to your point earlier, not a newsflash with the statement, but it truly is moving so rapidly that you might just have to wait a week or a month or two for a new tool or a new application to come out to do what you want. Like I was just talking to Travis, our project manager, and he said, "Hey, I just took an AI class and they just showed me how you can lay this tool onto whatever actual screen that you're looking at, and then it can pull data from there."
Yeah.
So he said, "Give me your MLS login." Sorry, RE Colorado. Gave him the login, and then we were running because our big thing is to your point, you're underwriting, and we're trying to run comps. How do we use that to speed up our process and make it,
Yeah.
super dialed? It was pretty damn good, and that didn't exist a week ago when I was kind of researching the same thing. So it's like maybe just wait a month or two.
You
And
could
you'll
probably
probably
build
hear.
some nice models out with the sales on the back end. You can kind of go through with your virtual tour and say, okay, this house, this location, what's selling, what's buyer behavior like, and can probably get pretty accurate at this point, actually. And that might help stay on that regimented plan for the sales cycle. And
Yeah. No, and so then that's kind of like the perfect segue of like where are we trying to go? So I know this is always challenging. It's literally the crystal ball, and my cheesy joke is like if you and I both knew exactly what was going to happen, we'd be on a private jet somewhere or not. But I mean again, you guys see so much data, you see so many transactions that as even semi-high volume flippers we're not seeing. But I would love to know, what are you tracking from a data perspective, and how are you feeling about 2026 in the real estate market, especially as it relates to us flipping properties
sure.
in Metro Denver?
Sure. Yeah. We track all of our internal loan data, underwriting analysis, budgets, and then, of course, we track more macroeconomic stuff and all that. And we always come out and say we don't try to time a market,
Yeah.
but there has been an uptick in volume,
Okay.
acquisition volume.
Yeah. It's good to know.
And I think we'll see more in the coming months and weeks too, I guess. How sales on the back end is going,
Yeah.
but it seems like that there's a bit of optimism out there.
Okay.
I don't think we're going to get more meaningful Fed rate cuts anytime soon. And we still have quantitative tightening going on on the Fed balance sheet. So I
Mhm.
don't see mortgage rates plummeting down again. So I think we have to assume we operate in the environment that we're in right now.
Okay.
So, but I do see, a supply and demand opportunity, particularly in the existing housing stock. So I think
Okay.
that right now is a good time to be in the fix and flip business.
Yeah. No, I think that's really, really well said. We're kind of seeing the same thing. I think people are licking their wounds. To your point, the seasonal nature, this is the time to buy. Spring and summer is obviously the great time to sell. No rocket science there. But if people are still at least getting the game, I would be a little concerned if you said, yeah, our volume is crickets. Nobody's doing anything. People are just stuck holding properties. Just seems like kind of that painful but healthy correction that we needed. Maybe not crash, but you're right. And that's the tough thing too, is when you were saying it that way, we saw a 10% pricing correction in 30 days. And with that particular deal, we didn't have to give up much concessions. But the other thing is the data doesn't take into account those concessions.
And to that point, we're seeing
That's
it's
a
usually
lot.
between 2.5 and 3.5% concessions right now on
Okay.
sales prices
Okay.
of the deals that we're involved in.
Yeah.
So, that's a meaningful piece of the profit too.
Yeah, you're right. If you extrapolate the sales price versus your net profit, yeah, that could be 40% of your actual profit.
Exactly.
Those numbers get painful fast.
Yeah, real fast.
So
Yep.
interesting. Okay, cool. Well, man, we've covered so much ground. Is there
Yeah.
anything else that you want to leave the audience with? Or we hit a ton of stuff, but I want to make sure you get anything else out there before we get you out the door.
No, I think we've covered a lot of things, and I'd be happy to chat more with anyone about it. If
Yeah.
there's follow up with any of your listeners, we see a lot of activity, we track a lot of data, and we do have a publication that comes out regularly called The Indicator, so you can email me or sign up online at indicatecapital.com, and we can get you on that newsletter. But there's a lot of good data in there that comes out too.
Yeah, actually, that would be the last thing I would love for you to leave the audience with is what's the best way to get in touch with you? They can get your newsletter, but yeah, give your information. We'll have in the show notes, guys. Should definitely give it out.
Yeah, you can reach out to me at jesse@indicatecapital.com. Go to our website, indicatecapital.com, and any one of us would be more than happy to help and answer questions.
Yeah. Okay. Cool. Jesse, it's been awesome having you on the podcast. It's been fun because we've known each other for a while. We did our first deal, which is fun. You guys sponsored the academy, which was awesome. So working with our clients, you guys get with Jesse and his team to help for all your hard money loan needs. But man, thanks for coming on. You guys, thank you for tuning in. We'll catch you guys on the flip side and have a great day.
Elevation, elevation. Did that last man, this money for the making. We gon' get it, hustle harder every day.